If you are your own business owner and you're doing private money lending where you can basically work from a laptop, that just gave our family pretty much 100% geographical freedom.
What kinds of returns are we seeing on these types of loans?
The standard model is anywhere between 15 to 30% for 3 to 6 months, and that's a flat fee. That's not annualized.
This is an opportunity for lots of other people to join in. Brokers, connectors. What are some ways that they can get involved?
Those are the basic two parameters, right? Like if you
Welcome to Nursing Real Wealth. Today I have the pleasure of welcoming back Eric Fuller, not only as today's guest, but also as my business partner. Eric has been on with us multiple times, sharing his wealth of knowledge as a private money lender, and now we are embarking on this journey together, providing fast, flexible funding for real estate investors. Eric, welcome back to the show, man.
Great to be here. Thanks for having me, Justin. Appreciate it.
You bet. This is exciting being able to host you on this time as as partners together, and sharing a little bit about our venture together, continuing what you and Logan began, doing these fast, flexible loans for people, bridge loans primarily. But before we get into that, I want to share a little bit about partnerships and just some nuggets, not deep, just some nuggets about partnerships and structuring things well, and the types of mindsets that we should have about that, so that we're serving one another first. Can you just share a little bit about how our partnership, from your standpoint, came to be? What motivated you to team up with me? Just let's start there.
Sure. Yeah, I'd love to talk about that. So, when you start building your own business, it's usually just one person, maybe an assistant, whoever, and you're grinding and you're getting things done. In our specific world of private money deals, that was just me looking for the deals. And then once I looked for them, teaming up with a transaction coordinator who could coordinate with title and do all the paperwork. And I was, everything. I was the front end, the back end, the negotiation, the processing. And in a lot of ways, I still am. I have an incredible transaction coordinator, Rochelle Odell, who's doing all our loans. But there's so many pieces and parts to this where I realize that it's not the highest and best use of my time. And it's not really what motivates me or drives me to spend my time so divided between all those different parts of the business. Right? It's kind of like that elementary school example. I don't know if you did that in elementary school, but a lot of times there's like that little object lesson where you guys are, they're assembling like a hamburger or whatever, and then there's one row of kids, and with one row, like there's little pieces of paper that represent the cheese and the burger and the lettuce and the tomato, and like one of the rows is all the kids are doing their own hamburgers all by themselves. They have to put them all together and no help, just by themselves. And then the other row is like one person's the cheese person, one person's the burger person, one person's the lettuce person. And they just go, 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 and you see who builds more. And the people that specialized have a better output, So I didn't realize this at first, but because I thought of it as all just one business, but there's so many different things to get done that really the best way to get productive and to make the business grow like crazy is to do the steps that I'm really, really fast and really, really good at, right? So in that whole burger or whatever, this whole private money loan, whatever analogy you want to use, there are some parts of that I am really, really fast and really, really good at, and I really enjoy doing. And there's other parts of that are just slow and tedious, and I don't like it. It slows me down. It's not the natural fit for the type of work that I like to do, and somebody else could do it much faster and better and even enjoy it more, because that's kind of their wheelhouse. That's the part that they like to do. So that's basically where the magic is, right? Like if you can find a partnership where it's got synergy, it's like 1+1=3, not 1+1=2. There's the parts of the business that I will do, which is like what I like to call the hunting down the deals. You've got to network, negotiate, find the deal, make sure it's safe, and then bring it to the table and get to a basic agreement of how it's going to operate. that's the part where I have done really well at, and finding a lot of them and getting them ready to go. The processing or the back end side of it is where I need some help, and that's where somebody who's a super integrator can really help. Where they might not be the person who is like, "Hey, I can't really go out and find a bunch of deals. That's not my natural inclination, or that's not my natural talent." But what I do really love to do is see a whole system and process where, hey, there's all these deals coming in, going out. There's all these operations, and you know, I'm so focused on just bringing the new deals in and making sure that there's healthy deal flow for us, that the processes and the operations aren't as efficient as they could be with somebody who loves and has a talent for getting smooth processes and operations. So that's what I see in you, Justin, is that you've got, from your past track record and your current abilities, a lot of capacity to take those systems and processes and make it just go really fast and really well. So another analogy I like is like the trains. Like what gets the visionaries excited is just getting a bunch of trains. Like we got all these trains chugging forward, all this business happening, and what I do best at is getting more trains to get on the track. So here I am throwing more and more and more trains on the track, but we need an integrator to keep the trains on the rails and to make sure that each one and the intersections and the junctions wherever are proper, right? Because if you just throw more of them on there, you're going to get a train wreck. So it's there's people who love like getting more trains on the rails, which is me, and then there's people who love seeing all of those trains and seeing how magnificent and beautiful the system can be when it all intersects and interacts and runs smoothly. So that's basically the where the magic happens, right? What they call it, the book rocket fuel. That's where the rocket fuel happens, when you've got both sides of that, where the people can really be efficient in their own sphere.
Yeah. Yep. Absolutely. Um, and I think, you probably alluded to it a little bit in your first partnership. You and Logan were both very good visionaries, and so there was a little bit of the kind of stepping on each other, because you were both doing similar things. You had similar visions, similar territories that you were good at, and were missing some of those synergies in that relationship. And so you and Logan recognized you both individually needed to have some integrators. But what I'm curious about, and when we look at the space of investing and we look at partnerships, a lot of partnerships don't go well, and a lot of partnership quote unquote breakups don't go well. Yours went really well, and what I want to point out is the amount of involvement Logan has had in your life and in my life, and his willingness to be sort of that third party almost, encouraging us and sort of mentoring us through this. And shout out to you, Logan. Thank you for doing that. I appreciate you so much. Such a incredible man. I have the utmost respect for Logan. But I'm curious, what are some of the measures that, or mindsets, or things that you took into account early on in your partnership that allowed you to recognize when it was time to move on for the partnership, and yet keep your relationship in deeply intact and strong? What were some things that you did early on to ensure that?
Yeah, that's a great question, and I echo all those words. Thank you so much, Logan, for all the things that we did and learned together. I'm very grateful for what I learned from him and how he helped me grow, and how he basically helped me take my business from little deals here and there to doing some much bigger deals with him. I'll be forever grateful for that and for what I learned from him. I think that one of the things that's actually interesting, you asked what did we do. I think it's actually really important too to say, like, what did we not do straight from the start? And what we didn't do straight from the start was just jump right into it and say, okay, here's the business. We don't really know what it is or who's doing what or how it's going to work, but here's a business and we're 50-50. Like we didn't do that. We took it one deal at a time. And for the first couple of deals, we didn't even have like a set we didn't even have a set split between us and like whatever percentage of the private money deal profit would go to us. It was, I had a deal that I needed more funding than my personal funds because I already had them out in other loans and things. And somebody said that I should talk to Logan about that. And I'd already negotiated what my cut would be. Like I think it was, what was it? 45,000 profit on that deal, and like I wanted 10,000. So I basically pitched the deal to Logan and said, "Hey, this is a deal. It's a 35K profit." And Logan already knew that he had a partner that could fund the deal. So he and that capital partner were able to work it out. And then he got a good split off of that. The capital partner got a good split, and I got the um, the 10K on top of that. So that's, that was the first time that we really did a deal together. Then we started seeing more of them. We saw that there was potential interest in working together. So eventually we did get to that point where it's like, okay, whatever the fund manager, if you will, split of these are, then we'll divide that. And we started doing so many of them that we just drew a line in the sand where we're like, okay, doesn't matter who finds it, doesn't matter who brings the capital partner, like we're both gonna split these. And that was another thing that was kind of fluid, where like originally it was I'm finding the deal and he finds capital partners, but those lines did start to cross a little bit because I would like he would find a really good deal, for example, and then I would find a capital partner because we needed more capital for it. So that was yeah, that was what we were doing, and it worked well for what we were doing to kind of get proof of concept and to get things going. But like you said, we ultimately ended up taking up the same space where like we're both the deal finders and the capital managers. We're both kind of very visionary front end, and we needed somebody to really hone down on the systems and processes for us.
Yeah. Yeah. Well, and even though there might have been two visionaries together, I think in so many ways, your partnership is a great model for a lot of other folks. A solid, model of refining and sharpening one another. The scripture says, "Iron sharpens iron," and so a great friend and a great partner, and I think in a good business partnership, iron's going to sharpen iron. Iron's going to challenge one another. Each other is going to challenge one another to be better, to elevate, and to enhance one another's strengths. And so I would say that even having to step away from that partnership is actually a sign of the strength of the partnership, that you recognize that there was time for an even bigger growth. And I think there's a lot to take away from that. And I don't want to dwell deeply on that today because we really want to talk about the business ventures, but just wanted to highlight that because I think there's a lot of wisdom in how you guys managed your relationship with one another that could be spread out across the community of investors to just encourage one another to that level of integrity as they handle one another in their business relations.
Yeah, for sure. And just like I would say, do more deals together before you do official partnerships together, because especially in our sector of real estate and private money lending, like you can do each deal where like everybody has their separate LLC, and there's my LLC on the JV, and there's Logan's LLC, and there's another capital investors LLC, and we're together for that deal. And you can do that for one, two, three, four deals with a potential partner to see exactly how everybody operates before you say like, okay, this is the official partnership and this is how it's going to work. And because we had that structure as well, like we were partners working together, but Logan and I never had like a shared bank account, for example. We didn't get to that level, and we didn't really need to because we just had our separate payouts for each deal, and we got the money, and it was fine. But yeah, I would just say to be cautious before and get to know people really well. Do a lot of deals, do a lot of business together before you actually get to those parts of officially joining, whether it's an LLC, a bank account, any of that kind of stuff, for sure. And it makes it easy to say like, hey, like when you're still like separate parties in that regard, it makes it easy to transition out because it's it's not really a business divorce, if you will. It's just like, hey, we did a lot of these deals together and it worked out well. And ultimately, Logan wants to do more a different type of capital raising and more focused on growing his own equity and getting more properties and things. Um, Not really the type of quick private money loans that we're doing. And so that's the thing to look for in the partnership as well. Like Logan's good at identifying, okay, where are we now? Where do we want to be 1 year from now? And we don't really know where we're going to be 5 years from now, but what might that look like? So like, do you and your partner, like, is that your life goal? Like, you need to think about personally, like, what do you really want to do in life, right? Do you want to be doing this same business 10 years from now, 20 years from now? Or is this just like a 3 to 5 year thing? Do you want to exit it in 3 to 5 years? Like both of the partners, the more you can have those upfront conversations, the better.
Yeah, yeah. It's not just what is your business, desires, your business values. It's also understanding a little bit about your family values and personal values too. Some people are gonna work 7 days a week, 24, 7, like they're available all around the clock, and that's their dream is to be that person. You know, sort of the Alex Hermosis of the world, right? Where
Hmm.
they just drive and they eat up business 24/7. Um, and then there's going to be others who really are in this for their family, and so working, long hours, 7 days a week is not an option because doesn't it doesn't work with their values.
Yep.
And
Yeah.
so, yeah, that's an area where we're similar, in particular, and I think where you and Logan were similar is that the weekend is really intended for family.
Yep.
It's time to be able
And
to
nighttime even.
calibrate. Yeah,
There's plenty of times when there's a deal that I got to work on at night, but I really try to separate that time when I'm at home with family. So there's lifestyle entrepreneurs and there's the grind and grind entrepreneurs. Logan and I were both lifestyle. So if Logan was like, "Hey Eric, I'm going to go on a hunting trip for a week," it's like, okay, well, if I need you, like try to check your email once a day. Like, and I told him like, "Hey, I'm going to be traveling this week, or I'm going to be with family doing this." I might be on the beach with my family one day that we're going to take off because it's a holiday or whatever. But there's still a loan that's closing. Like he might pick up the slack there. So yeah, it's very good to understand that. And on those lines too, I don't think you necessarily want to define the business contribution just based on time. Like at the end of the day, it's all about value, right? So definitely you don't want it to be where like one partner is doing 80 hours a week and the other partner is doing 20 and it's a 50-50 partnership because that's not going to feel right or fair. But really the best way is to not even think about it in terms of time. Just think about it in terms of productivity. Like this is how much value I can bring and this is how much business I can bring. This is how much value the other partner can bring and how much business they can bring. So just defining it based on that helps keep the operation efficient and helps keep the interests aligned and both parties motivated.
yeah, absolutely. Yep. Which is a shift in mindset for anybody who's coming from W-2. Definitely a shift in mindset for
Hmm.
me. It's so easy to get caught up in, I'm not giving enough time to this. Well, what value are you bringing? And that's key. And to make sure that you're bringing, significant value in whatever it is that you're choosing to do.
Hmm.
Well, moving on, I do want to spend the majority of our time talking about the specific venture that we're doing in the private money lending. And already, Eric, you have deployed millions of dollars into private money loans. Um, can you just briefly, for anybody who's a little bit newer to who you are, explain what drew you initially into the private money lending space and what's keeping you here?
Yeah, that's a good question. So, I mean, ultimately, the answer is family, like we just talked about, right? Like I had a W-2 job. I was a biomedical engineering teaching professor at the University of Florida. So I was teaching the senior design class. I really enjoyed working with students and teaching them and doing the engineering projects, but it just wasn't the same kind of freedom that real estate can buy, like especially if you are your own business owner and you're doing private money lending where you can basically work from a laptop. That just gave our family pretty much 100% geographical freedom. Like we can live wherever we want. And if I want to work an 80-hour week, I can do it and get a lot more business. If I want to work a 20-hour week and just not get a lot of new business, but sustain things and keep it going, then I can work 20 hours and go watch a bunch of my kids' games or birthday parties or whatever. It's way more flexible. So real estate is a massive ocean. There's a million different things you can do in real estate, but private money lending specifically is nice for several reasons. I generally don't need to be there in person at the property because we've got, other boots on the ground people that can walk through and check it out, and we can see public records, we can see appraisals, inspection reports, and all that kind of stuff. And then we can sign documents electronically, send them electronically. Sometimes there's mail required, but there's a TC that can help with mailing addresses and that kind of stuff. So private money lending is great for geographical freedom. And when you do the higher return, high yield, high security private money lending like we're doing, it is enough to feed your family, to support yourself, and even more than that, to start getting some significant money back from investments and grow that faster and faster. It's it's enough to make a good business out of if you're doing it in the creative way at the high enough return that we are.
Yeah, absolutely. And as asset-based private money lenders, we particularly emphasize the speed and the flexibility. So fast and flexible financing. Why would you say this is an essential tool for borrowers to know exists? And what kinds of situations make this service particularly valuable?
Yeah, there's plenty of times that this is valuable. So, and just to clarify, like different types of private money lenders, you might have your old grandpa or old grandma at the country club, which is a, slow moving, get comfortable with you, require a 20% down payment, and then they'll give you a really low rate. Like in the private money world, 10 to 12% per year is considered a low rate these days. So they'll give you that loan, and you can do that. We are a lot higher than that rate and a lot shorter term. We're not going to keep it for a full year, even for multiple years. We're, helping people get in and out, wheeling and dealing kind of stuff. But it's a tool in somebody's tool belt because everybody's a cash investor and they don't realize that. People think that they have to have cash to make the big real estate moves that they wish they could make, but they just can't. So they're restricted from some of the best deals. But that's not true. I told somebody that if they wanted to work with me, it'd be expensive, like sometimes up to 10% in 1 month. And that's not the case for all of our deals. We've done plenty of deals that are less than that, or like, 10% in 2 months or longer than that. But when I told him that, like, he's like, 10% in 1 month, that's 120% a year. Like there's no way that I could sustain that rate. And I explained like, yeah, well, it's not meant to be a long-term thing. This is like quick money that we bring to the table to help you elevate your game, and then we can both win. So if there's a property that you see that you can buy cash that you would otherwise wouldn't be able to get, then we are giving you a superpower. Like you are now transformed into a whole different level of investor. And he said, yeah, I think that's right. Let me think about that, and I'll let you know. So 2 weeks went by, and the guy calls me back and he says, hey, I've got this house. It was in the Midwest. It's about 100K value, needed 60K on it. And he said, hey, I got this house. I need 60K. I need you to close pretty quick in like 2 or 3 days. It's 100K as is value. You'll be first lien position. There's a tenant in it. It's ready to go, clean, good. Everything is fine. And I'll do that rate of 10% in a month. So that's a way where, and when we closed that loan, we got him paid out. That's a way where he got a really good deal because, like, of course it was 10% in a month, so it was a really good rate of return for us on that specific one deal. But for him too, like it was more expensive than another loan, but he didn't have any hard money lender. There wasn't any bank. There wasn't anybody else So he just thought he couldn't do that deal until he knew me, right? So with this, with this one too, like he got the better deal than us because he got 100K house that he would have bought for 60K if he had that in his pocket. But then he just got that for the increased price with our fee on that too to, to come in and help. So when you look at that scenario, like that scenario happens all the time, but even bigger. Like think about that in terms of a 600K loan. And we've done, like we just recently closed 650, 1.2 million, 850K, 425K. Like we've done a lot of these bigger loans, and all of them are a pretty similar scenario to that. Sometimes it's a purchase, where like, for example, there could be a really nice home or maybe a multifamily that's worth 800K, and somebody sees that, hey, that the seller's looking for cash really, really quick. They'll take 500K if someone can bring cash to the table super fast, right? And already automatically, so many investors are going to think, man, I wish I could have that property. Whoever scoops that up is going to get a steal. If I just had 500K in my pocket, I could snag that property and I would love it, but I can't. Like it's just changing that mindset. It's like when you work with us, when you work with the right private money lender, you are essentially a cash investor because we bring the cash to the table for you. So now you snag that for 500K plus, something for us so that you refi and get us out and get into a lower rate loan. But, it's going to be a little bit more than 500K, but still you get so much equity in the deal that it's a massive win for you. So there's that scenario in the purchase. Um, in the refinance, it's the same thing. Like we've had NFL players come up to us where they're basically saying, like, hey, I've got a business opportunity that I need 650K for. This was a specific example we did. And they had an asset that was worth over 1 million. And they said, hey, here's my property. It's worth over $1 million. I just need, 600K, 700K quick. Can you get that to me? And I said, yes, that's what we can do. So like nobody else could bring the money to the table that quickly for them. So that's the scenario. Like we're very, very fast and very, very flexible.
So essentially, he had lots of assets, didn't have a lot of cash in the bank, and an extremely lucrative opportunity in business, and no
Yep.
ability to access it had he not known us.
Yep, exactly. There's a lot of ways that you can say it. You can say, when you partner with us, we're going to get a cut. Like we're more expensive than a hard money lender or a bank. So in that way, we say we're expensive, but we're fast and flexible. You can say that it works well for people who are house rich but cash poor, like people who have a ton of equity in their house. And if they're not in a rush, if they're like, hey, I need this money in like a month or 2 months, then we're really not the best option. They should go talk to somebody else. They should go get a HELOC on that house, a home equity line of credit, or they should refinance themselves and get some cash out in that cash out refinance, right? Like they shouldn't go to us if it's not a not a pressing need because they can find a much better rate somewhere else. But that's our superpower. Like I'm talking about, we bring cash to the table quickly for people who are house rich but cash poor.
Yeah, yeah. And you mentioned some of the dollar amounts that we're able to move, and those are dollar amounts that can be moved in relatively quick turnaround times. What kinds of turnaround times are you comfortably capable of moving that kind of capital for someone?
Well, the generally we like to talk about the range of 3 to 4 days. We consider that rush and very fast to get like all the documents, all the underwriting, like everything done and ready to go. Um, I have done some deals in 2 days. That's definitely feasible as well if we can get comfortable with the collateral, and the borrowers are also quick to respond if they've got their pictures, their detailed comparable properties or comps like we call them, maybe even a CMA or an appraisal. CMA is a comparative market analysis where it details the comps and the pictures and the locations and all that to just make it easier for us to analyze those comps. So if the borrower's on top of it and they're getting stuff to us quickly to be able to underwrite it, we can move really quick. I don't like to advertise same day. I have done same day. I don't like to. I have come in and done same day funding on a few occasions, but that would be a very, very wild and crazy rush to get things done. So even one day, like when somebody comes to me like, hey, today's a Monday, I need funding tomorrow, Tuesday. it's theoretically possible because I can pay the borrower, we can have them pay a rush fee to the attorney for the attorney to just draft the docs really, really quickly and get it to title. Um, so yeah, it's theoretically possible, but it's usually best to count on like the 2 to 3 day range. And there's caveats there too. We just, want to be really careful about that. Like some people are like, oh, well, how fast can you be ready? And I can be ready really, really quickly. I can like the money's here, the money's ready to go. We got to get comfortable with the asset. So the pictures, the comparable properties, like the condition of the house, like that's pretty quick. And then the attorney drafting the documents, like we've got an attorney who is incredible. We've got backup if he's not ready. That's we can get all that done really quickly. But there's a title company that just doesn't have the title commitment ready. The clean title policy that says there's no other loans or liens or problems with the property, like legally, where they might owe money to somebody here or there and they're securing it by the property. For the title company to give that lender's title commitment, like some title companies take 2 days, some title companies take a week. A lot of times, like the borrower say, like, "Hey, I need it in 2 days," but I've already got a title company that has been working on this and they've got the lender's title commitment. That makes it a lot easier. And that's usually the one thing where I have to give a caveat. I'm like, have you already started the title process? Because if you don't have a clean title policy, I can be 100% ready to go. But if the third party title company isn't ready yet and they're not ready to finally stamp off and close your file, then it might take a little bit extra because we're waiting on them, not waiting on me.
Yeah. Yep. And you alluded to this earlier. Um, our our loans are often described as expensive, but I guess the
Mhm.
question really is: are they really expensive given the types of movement that we can make and in the time frame that we can make? What would you say to that?
I'd say that we are expensive and we pride ourselves in being expensive, but making like Superman moves that a lot of people couldn't make. Like I said, we closed 1.2 million very, very quickly. I've got another deal that's over 2 million that I'm looking at right now where it's kind of the same thing. And they're willing to pay a really good rate on that because they need to pay off debt on an asset that's worth way, way more than that. So I guess if you want to use like an analogy for like a steak and different cuts of it or whatever, like, you go between ground beef to top sirloin and you get better and better quality there. The most expensive stuff is you pay a lot for it, but it's the best, right? So in terms of private money lending, when you want the best speed and flexibility and the owners of the company, their direct cell phone numbers on speed dial, just like, hey, we need to get this done. What do we need? How can we do it? I need money quickly. Like, we provide the best option, the best experience, the best speed to get that. And that's why the rates are going to be a lot higher than like a mom and pop private money lender that's been doing it for 20 years that moves slowly and just gets more comfortable with you and the borrower and could take a while to get it done. It's what we say, it's expensive, but it's fast and flexible. So if that's what people need, then that's what we do. And you'd be surprised. There's so many people that when they hear that, they're like, I get it. Like I get it. It's going to be more expensive than another private money lender who moves slower, but that's what I need. Like I need sometimes there's like, hey, there's a deal that's really, really good that pops up that I just need cash for. Like they're willing to pay that. And some people pay 50-50 to partners, like some people have a partner where it's like they find a really, really good cash deal that they can swoop up, pay cash, and then like maybe fix and flip, or not, maybe not even fix and flip, maybe just like a wholesale model, like you call it, where it's just a really, really good cash deal on a house. All they got to do is deep clean it, throw away the trash, like get the magic eraser out and scrub the little scuffs, marks off the wall and stuff. Like a really, really simple trash out and deep clean, and then you sell it for way more. Like a lot of times people will get a cash partner who will just be a 50-50 partner with them on that. Like, hey, I'll bring the cash. You go do what you want to do, boots on the ground, get it ready to list. We'll sell it and then we'll split it 50-50. We're actually a lot less than that if there's a good profit margin. Like, hey, we're not asking for 50% of the profit. We're just asking for a set rate of return for bringing the money to the table this quick. So we can be a lot cheaper than a partner who's 50-50 in those kind of scenarios.
Yeah. Yep. And are there any types of deals? I already know the answer to this, but I would love to provide the opportunity to share what types of deals. I guess maybe I can rephrase it. What types of deals do we absolutely not do?
So there are, yeah, for sure. I mean, we bring money to the table really quickly, but we have to be very, very comfortable with the asset. For that reason, we go lower loan to value than a lot of lenders would. Like, to make numbers easy, let's say it's $1 million, right? It's $1 million asset. Some lenders would be like, okay, we can do 80% loan to value, or $800,000 loan against a 1 million property, or 75% loan. That's $750,000 against the $1 million property. We stick to 70% or below in first, and 65% or below in second. So yes, we do second position liens, but a lot of the times, if they've already got a hard money lender purchasing it and the hard money lender is already at 70 or 80%, then we couldn't do that. We need to have additional collateral with a different property to make up for that. So, anyways, there's that's one of the biggest filters, is just loan to value, understanding what that really is. And the more rush, or the more unique, whatever you want to call it, the more different that the property is. There's not a lot of good comps for it, etc. In that kind of scenario, we just get more conservative, because we have to be comfortable in the worst case scenario that we just end up with the asset. Like, if the borrower vanishes, then we've got to find a way to get our money back. We got to take the asset and sell it. So, the quicker it is and the more unique the property is, the more conservative we are on our number of what the property is really worth. And then we say, okay, this is what we're really comfortable with as a number for this property. Now we're going to take 70% of that and do a first position loan on that. So loan to value, that's a big thing, where you've got to be really comfortable and confident that there's plenty of equity to protect and secure the property when you lend money. And so when we lend, that's usually the reason that we say no, is because it's too high. Like, borrowers want too much money for the asset. Another one is the state that we're lending in. So there's plenty of states where the state laws are fine for us to do what we're doing in our private money loans. There's several other states where, due to the lending laws and their procedures, it just is either not allowed or just doesn't fit our model very well. So California and New York are the two poster children where it's just really, really hard to do the kind of short-term private money deals that we do successfully there. So we just say no to those. I mean, if you have a property in California and New York and you want to come to us for some quick cash, then the best way for that is just see if there's a partner, or see if you or somebody else has property in a different state. Like, is there an Arizona property, or a Georgia or Minnesota? Like, is there anywhere else that you or a partner has a property that could be offered up as collateral, so that we can secure the loan based off of that?
Yeah. So essentially, the loan is issued in a totally different state. Money is used in California, but we're subject to the laws of a better, more investor friendly state.
Yep, exactly. And on those lines, like, it doesn't even have to be real estate related per se. Like, you could have this marketing agency, you could have this car wash, you could have whatever, where you're like, hey, I really need some money for a certain business development, right? And I need money quickly. How can I get money for this business? Well, if you have a real estate collateral, if you have a house that's worth a lot of money, or you've got a rental property or whatever, that we can have security based on that, then we'll give you money to go do essentially whatever business it is that you need to do it with. We're just securing ourselves with the collateral that you've against the asset. Yeah, it doesn't have to be like a lot of hard money lenders or other private lenders. Like, it has to fit in this box. Like, you have to be giving me this loan against this property because you're going to get it and then refinance or sell it. You're like, no, you could just use it for business and then pay me back based off of business proceeds.
Sure. Okay. And what are some common exit strategies, I guess, for a short-term loan like that, off of, say, some of those things that you mentioned, cash infusion into, say, a marketing agency? Are they paying you out of the proceeds of the marketing agency? What are some scenarios that you've seen, just to give people some ideas about different ways they could use this, and then how they could pay back? How do they get out of that?
Yeah, for sure. So, I mean, they have to pay the loan back one way or the other, right? So either they get the money and then for whatever purpose it was, like maybe it was the flip in California when I wouldn't lean the house in California, I'm leaning a different house in Arizona, for example. So with that California property, they do the flip, they get paid out, and then they pay me out through there. Hopefully, with whatever else you're using on, like a marketing agency or whatever other investment you're doing, like you're taking a risk by putting your collateral up against that to get that loan. So that's one of the business decisions that the borrowers have to take very seriously. Like if I'm going to put up this real estate property that I have that's worth 800,000 bucks or whatever, and I need a 500K loan against it because I need to go invest it into these business ventures that I've got going on. Like they've got to be pretty confident that 500K isn't just going to go down the drain on whatever business venture they're going into, because if it does, then they just lost it and then they lost the collateral as well, or they'll have to refinance or sell the collateral and give enough of the proceeds to us to pay our loan back. So the best case scenario is definitely that whatever business purpose they took it out for, that they'll use that. Other scenarios are just the collateral itself, that property, they can refinance it or sell it and get us paid back that way. I think it's also good to note that you asked about like what types of deals we do and we don't do. It's also good to note and be careful about primary residences. So there's a lot of specific laws and protections and procedures with primary residences. So whoever is, it's a very common scenario too, where people are like, oh, I've got a lot of equity in my personal home and I want to go start this computer business, whatever it is. Like, hey, can you lien my primary home? No, they've got to have a home in an LLC. So if they have like, if I'm loaning to John Doe LLC, then that works, right? It's non-primary, it's their LLC that owns a home. That's, and it could be a rental or it could be like, whatever real estate purpose they have it for. Maybe it's a commercial rental, maybe it's a shop somewhere, maybe it's some outlets, whatever it is, but it's got to be an LLC that we're lending to company, business to business lending. It can't be John Doe in his personal name because that's
Could they could they quick could they quick deed a house to an LLC to leverage that equity, or are there restrictions on that?
that might be possible. That's one of the realms where it's best to, this isn't legal advice that we're saying here, so it's best for them to speak with an attorney and for us to consult with our attorney about that to make sure that that method would work properly.
Maybe state
But
by state.
yeah, it's always like the United States of America. We love all 50 of them, but all 50 of them have different rules and requirements and procedures. So this, you'd have to confirm that. But in general, like theoretically speaking, it is very possible to do that because people do that all the time. Like people will have a primary residence for a year or two, and then they'll move out and they'll use that primary as an Airbnb and they'll get a new primary residence, right? So that's, it's totally possible for us to give a loan against that previous primary residence if it's an LLC to LLC loan. But we just got to be careful there to make sure that it's actually, that they took it out of their personal name, they put it in the LLC, they've made it very clear that this is for business use, this is now a rental, this is not our primary. And there could be some other ramifications there as well, like if they were claiming the homestead exemption on their taxes and stuff, like that's, we need to get rid of any sort of association that is a primary for us to do the business to business loans. So they'll have to make sure that that homestead tax exemption is on their new primary as it should be. And that now the previous house is just purely business purposes.
Yeah. Yep. Briefly, I want to talk a little bit about returns, just mostly for those who might be interested in being also capital partners, in the future. What kinds of returns are we seeing on these types of loans?
Sure. So I say that the standard model is anywhere between 15 to 30% for 3 to 6 months, and that's a flat fee. That's not annualized. So if we say 15% on 100,000, that means that we bring 100,000 to the table for the loan, and then we get back 115,000. It's a flat rate, 15%. 100K goes in, 115K comes back out. And it could be on the lower end of that. It could be like, it doesn't mean that 15% is 3 months and 30% is 6 months. We've done some 6 month ones at 15 to 20%. We've done a 3 month one at 10%. But there's also ones that are higher as well. Like it just completely depends on the scenario, how comfortable we are with the asset, how low the loan to value is, how low the state laws as well, like how comfortable we are in that state. If it's one of our top states that we lend in often and it's a very low loan to value first position, then we'll be glad to give the lower end of that range. But if it's a very, very rushed loan in a new area that we're not as familiar with, then that's where it's going to get into the higher range of it. And for the capital partners specifically, like we do a model where we don't make any money unless we perform. And that's why we've been blessed to have lots and lots of capital partners who are interested. I currently have a small, tight knit circle of partners who are ready to invest with me. And for clarity, I invest a lot of my own money as well. That's how I started, just doing this completely on my own with my own savings from previous real estate flips or purchases, or money from the engineering job. I just throw that cash in and get more back on these private deals. A lot of the bigger deals too, like if I'm asking for 1 million, 2 million, whatever to do in one deal, I'll make sure that I bring a significant portion of that myself on most of those. If I have it liquid, I might as well, because it keeps my money working at a high rate. And beyond that, it helps a lot of the other capital partners understand that I'm not just like theoretically asking them to do something that I don't do. I do this as well. I throw my money out there into these as well. So yeah, for capital partners, the deals have such a good security and high rate of return. Like it's what we call the unicorn deals. Like most deals are either really high return but low security, so it's risky, or it's a really, really high security but low return, like a treasury bill, something like that. We're looking for both. We're looking to have our cake and eat it too, by having very, very good security, like low loan to value, but also very, very good return. And the niche that we occupy there usually just means that we bring money to the table really quick. And that's why we have that value add that others don't. So anyways, for the capital partners, they just have to be able to get the funds ready relatively quickly as well to fund these. But they love the deals because they see how secure it is and how high the return is. And we don't make any money up front on it. So I basically won't make anything unless that deal performs. So I'm highly motivated as well to see it close out at the end. So like for example, if we tell a capital partner like, hey, you're going to make 20% in 5 months or whatever the deal is, like what that means is I tell them exactly what they're going to make. And then I explain like, and by the way, we make money because we have a spread above that. Like it might be 25% or 26% or whatever. We do like kind of that model that some syndications would do where it's like, 70 to 80% goes to the capital investor and then the 30% goes to the fund managers. That's the model that we do, to where like we're all rowing the boat in the same direction. We're all motivated to see it pay out. And then when it pays out is when I get it. And if there's ever, for whatever reason, if there's like, the worst case scenario, the property has to be taken over and we have to sell it quickly and we're just not getting the top dollar that we want, then they get the preferred return on that 100%. So they're going to get the full return that was promised, our capital partners will, and that all of that will be paid out before I make a penny on the deal.
Yeah. Yep. So it's a great opportunity for anybody with significant cash if they want to join in these ventures. But Eric, you have a vision for the future of the lending business. Where do you see us heading in the next few years?
Well, I think that we're at the stage right now where we've got a couple of trains on the track and we got a couple of systems, and we're just going to grow both of those, right? Like we're going to grow the operation to get more more deals coming in, and then just better, faster, more efficient systems to get the deals completely underwritten and packaged up and ready to close and out the door, so that we can do more business essentially, like the synergy I was talking about earlier. So just essentially growing the business, doing more deals. And that does mean that we're going to move towards bigger deal numbers. I'm even now, like today, people come to me and ask for a 20K or a 30K loan. And I tell them, like, look, I'm sorry, I'm probably not the best person for you. Like, if you're really in a pinch, I can do the 30K loan for you, but it's just going to be so expensive because it's not worth my time to do like a 10K loan, for example, and then 15% of that, that's $1,500. It's not worth my time because I can do $1 million loan on 15%, and that's 150,000, right? So it just makes so much, yeah, and it's essentially the same amount of work to underwrite, to vet the borrower, to do the promissory note and the deed of trust and all that. So we're really focusing on those bigger loans. We can do smaller ones, like, like 50K is still at the point where it's just going to be so expensive for our time that it's really best that they find somebody else, unless they're really in a pinch and like we're just going to save their deal and they're going to make so much money that it makes sense to give us like a pretty hefty chunk of that 50K in return. Um, but yeah, so there's 100K and 200K deals that we're still closing that are, it makes sense when it's a high enough rate of return there. But the big focus is really on the 400, 500, 600K, that kind of range. And then even up to like the 1 million, 2 million, because then we just get so much more money working so much more efficiently. So we're working on those because that's just the way to grow the business and to scale, and then getting better operations. Like I said, I think that's kind of like the next 6 months is just getting better deal flows, better automations, better operations, and getting more of them closed. And then the next year to 2 years is, the dream is of course to get more people on board, like get more people on to be an underwriter, get someone else on to be kind of like a commission based salesman who would do what I do, somebody who's motivated to go out and find these deals and wrestle them down and then bring them to us, and we'll take care of funding them and the whole back end processing and everything. Like, just getting more people on that. And then eventually, who knows? Nobody knows exactly what's going to be happening 3 to 5 years from now, but the best thing would be for you and I both to be able to scale back a bit and to say like, hey, we've built this incredible thing. Now we can hire a CEO, like hire a manager, hire somebody out there that can run this, and they can still make a very healthy salary plus a bonus based on the performance of the business. Like somebody 3 to 5 years from now could come into this and absolutely have an incredible business to run. And by the way, not only just running the business and getting a really good salary from that, but potentially investing their own money in it too. So when they have some money to invest, they can also grow that at a high rate like we are. So that's kind of the big dream, is that somebody else can have an incredible opportunity to join us and to gain a big opportunity in this business, and or probably some equity in the business too. But then that'll allow you and I to basically be in full control of that dial, right? Like, do I want to work a 40-hour week? Do I want to work a 20-hour week for this specific business, right? And that won't really affect the business that much like it does now. Like I said, if I take a 10-hour work week now, I can theoretically get away with it. Just the business isn't going to grow very much. It would just sustain the current deals I've done, and then nothing's coming in the future. So then it'd slowly dwindle down. But to get to the point where it can even be sustained and grow with less input from us, because we've got some people really pushing it forward on our team. Like 3 to 5 years from now, that would be a very, very amazing milestone to achieve for us.
Yeah, agreed. Agreed. And it would offer the opportunity for, just kind of from a strategy standpoint, the opportunity to focus attention as well on other ventures that, might be, exciting for us to be able to get into, other opportunities, wealth building opportunities.
Yep,
This is
definitely.
still technically active income, I guess on paper, right? I mean, it's It's about as passive, active income as you can get, but the government's going to look at it as income, it's taxable income. And so we want to get to that point where we're both investing in things that are generating that wealth for our families, something that our families can inherit.
Yeah, exactly. And for everybody who's interested in doing this kind of business model, the best thing to pair this with is a really, really good operator who you can put money with to do long-term holds. So like this type of short-term private money where we're in and out and we get a really high return, especially if you're a full-time real estate professional, so you can have special tax benefits where you can count the depreciation against your active income and all that. Like if somebody wants to either do what we're doing by finding these deals and making a really good income finding them, or by investing your money into them and growing it really quickly, you're going to make really good short-term money. Then the only problem is you got to have a tax write-off and long-term money. So the best thing to do, which I'm already starting to do, by the way, is to get all the really good returns from this, the short-term money that's hitting your bank account, and then invest that some of it back into this business because you're going to get compounding returns on this, but then take some of that into a really good real estate acquisition where you can have an operator that you'll really trust who can take your money and then you'll be 50-50 partners on some rentals, whether that's, co-living or pad split or even just a good old fashioned long-term rental, short-term rental if you're comfortable with it. There's, especially with the creative finance world that we're in, like subject to seller finance, or maybe somebody's getting a primary residence where they can only do a 5% down payment and move into a quadruplex. Like there's plenty of ways where even something as little as 30K can get you into a house, which is crazy. A very valuable house,
And a
that
house that's going to give you an exponentially higher write off on your income for that year. Just a small investment into it, exponential write off. Yeah, brilliant. Closing thoughts. Want to touch on, for those interested in joining us on this journey, because this is not just for us. This is an opportunity for lots of other people to join in. Brokers, connectors, people who are great at networking and finding these opportunities. There's a lot of opportunity to bring those deals to us, but I would love to let you speak to what are some ways that they can get involved right now with us.
Yeah, of course, we would love to have more partners. You can never have too much deals or too much money, right? So those are the basic two parameters, right? Like if you have money and you want to invest, then that's one simple way. Although I'll say that we have enough partners now who are just repeat partners coming back wanting to do more, that's usually not the bottleneck. But it's possible, especially when you have a larger sum, and then we find a deal that's a $2 million deal that's very, very secure, or 3 million, and we might need some extra. So when somebody has a larger sum of money, that is great to have that connection. So that's the one side of it, right? Money. And then the other side of it is just finding the deals. So if somebody, even if you don't want to officially partner with us, you just happen to know somebody, you're like, oh, holy cow, that fits Eric and Justin's business model super well. Like I know at the last real estate meetup, Emily was saying that she has this really, really good opportunity. They're just on a time crunch. Like, man, if they could get 200,000 cash, they could get this incredible property and do all these things with it. Like that's who they should, that should ring a bell in your head. Like, oh, that's Eric and Justin. Like they'll bring that 200K cash super, super quick, and they'll allow Emily to take down that property, and Emily's going to make a crazy $80,000 profit on that. So yeah, it makes sense for us to go in and out and get our fee on that too, right? And because you went to the real estate meetup in your local town in Knoxville, Tennessee, or wherever on earth you are, and you found out about that person that needed that cash quickly, and you brought them to us, that's when you can get the broker fee on it. We've paid out, the record is 42,000. We've paid others commonly that are 10, 20, 30,000 in broker fees and points, just because, these are so lucrative and so secure of deals that people understand that. Like we pay out high fees, and a lot of people love being that broker or that connector with us because it's so fast and so easy, so straightforward, right? Like if they're going to be a broker for a big bank or a big mortgage company, Wells Fargo, Chase, whatever, it's so much paperwork, it's so much time, and that they've got to collect the 5 year, residence history and the job and the pay stubs and the dental records and like
Yeah.
whatever. They got to collect everything from these people, and then it takes a long time to close, and they might make 1 or 2 points. Like we commonly pay out 3, 4, 5, 6 points on some of the big crazy deals, and those close fast. So it's less work and it's a bigger payout, which is why we've got also a lot of people bringing us deals because they know that they're going to make a good paycheck really quickly. So if you're good at talking with people, if you're good at that kind of sales commission based negotiating kind of thing, then you can definitely make a lot of money bringing these opportunities to us.
Love it. And I'm going to put in the description down below a link to our mailing list. You can sign up for our mailing list and you can get a free access to our webinar where we talk specifically about these high yield, high security deals. And then also we'll send out reminders for our office hours that are every Friday at 11 o'clock in the morning, Eastern Standard Time. So those are some practical ways that you can connect with us. You can also shoot us a DM on any of our social media. Eric, I don't know if you're very active on Instagram, but definitely you're active on Facebook. I'm active on Instagram and Facebook. So either way is a great way to connect with me. So Eric, thank you for joining us once again, for sharing your thoughts and insights. And it's been a pleasure delving into this business with you, and I look forward to the future of it. To our listeners, thank you so much for tuning in. If you enjoyed this episode, please like and subscribe to our YouTube channel. Love to hear your feedback in the comments below. Join us every other Tuesday for more insightful discussions on nursing real wealth. Have a great day. God bless.